tech and internet arenas. Could you share your views on the potential fallout from this speculation for the general economy? And secondly, how long did it actually take you to perfect that curveball? And are we going to see it tonight?
I don't think I want to give anything away about my pitches tonight. Ernie Banks may be in the audience. I know he's in town, and I just can't afford to do that. But you'll see it tonight, and you can describe it any way you'd like. The question about the high-tech stocks and possible fallout. Anytime there have been real bursts of speculation in the market, that it does get corrected eventually. Ben Graham was right when he said that in the short run it's a voting machine, in the long run it's a weighing machine. Sooner or later, the amount of cash that a business can disgorge in the future governs the value it has, that the stock commands in the market. But it can take a long time. And it's a very interesting proposition. For example, if you take a company that in the end never makes any money, but the trade changes hands representing a valuation of 10 or 20 billion dollars for some time, there's no wealth created. There's a tremendous amount of wealth transferred. And I think you will see, when we look back on this era, you will see this as a period of enormous amounts of wealth transfer. But in the end, the only wealth creation comes about through what the business creates. There's no magic to it. If a company that's not worth anything sells for 20 billion, and 5% of it changes hands, somebody takes $1 billion from somebody else. But investors as a whole gain nothing. They all feel richer. It's a very interesting phenomenon, but they can't be richer except as a group unless the company makes them richer. And it's the same principle as a chain letter. If you're very early on a chain letter, you can make money. There's no money created by chain letters. In fact, there's the frictional cost of envelopes and postage and that sort of thing. So the net, there's some money destroyed a little bit. And there's money destroyed by the frictional costs of trading and investing. That comes out of investors' pockets. But the manias that periodically take place, and not just in stocks. We had a similar mania. Well, I'm not necessarily similar. We certainly had a mania in farmland here in Nebraska 20 years ago, and land which couldn't produce, we'll say, more than $70 or $80 an acre would sell for $2,000 an acre at times when interest rates were 10%. Well, that math will kill you. And it killed the people who bought it at those prices, and it killed a great many banks here in Nebraska who lent based on that sort of thing. But while it was going on, everybody thought it was wonderful because every farm was selling for more than the similar farm had sold for a month earlier. And it was momentum investing in farmland. And in the end, valuation does count, but it can go on a long time. And when you get a huge number of participants playing with ever increasing sums, it creates its own apparent truth can be for a very considerable period of time. It doesn't go on forever. And whether it has fallout to the whole economy, like it probably did in the late 20s, or whether it's just an isolated industry or sector where the bubble bursts and it really doesn't affect other values, who knows? But 5 or 10 years from now, you will know. Charlie?
Well, I think the reason we use the phrase wretched excess is that there are wretched consequences. If you mix the mathematics of the chain letter or the Ponzi scheme with some legitimate development like the development of the internet, you are mixing something which is wretched and irrational and has bad consequences with something that has very good consequences. But if you mix raisins with turds, they're still turds.
That's why they have me write the annual report. So I think we better move on to Sector 3.
With technology, computers, electronics, and software transforming our entire world, not just here, the world, I must admit that I personally invested in 4 technology, computer, software, and aggressive growth mutual funds and made up all of my 1999 losses on Berkshire Hathaway. Are we asking too much as shareholders of Berkshire Hathaway for you men to put your brains to work and possibly speculate a little bit, maybe 10% of our money into the only play in town, which seems to be technology, electronic, and I've read your report and I understand a lot of your reasoning that it's difficult, and it is difficult, to project earnings of a lot of people. They're going to go bankrupt or they're going to go out of business, but isn't there enough left in your brain power to maybe pick a few and see what's going on? Because I made over 100% profit in 1999 on my aggressive position in the technology field. So that's
okay, well, the answer is we will never buy anything we don't think we understand. And our definition of understanding is thinking that we have a reasonable probability of being able to assess where the business will be in 10 years. But, you know, we'd be delighted. We have a man here who's done very well, and if he has any business cards, you know, you can always invest with him, and we'd welcome, you know, we'll give you a booth in our exhibitor section, and anybody that wants to do that is perfectly obviously free to do it with you or through anybody else that they select. Now, you have a whole bunch of people out there that say they can do this, and maybe they can and maybe they can't, and maybe you can spot which ones can and can't. The only way we know how to make money is to try and evaluate businesses. And if we can't evaluate a carbon steel company, we don't buy it. It doesn't mean it isn't a good buy. It doesn't mean it isn't selling for a fraction of its worth. It just means that we don't know how to evaluate it. You know, if we can't evaluate the sensibilities of putting in a chemical plant or something in Brazil, we don't do it. If somebody else knows how to do it, you know, more power to them. There are all kinds of people that know how to make money in ways that we don't. But, you know, it's a free world and everybody can invest in those sort of things, but they would be making a mistake, a big mistake, to do it through us. I mean, why pick a couple of guys like Charlie and me to do something like that with when you can pick all kinds of other people that say they know how to do it? I would say this, incidentally, you mentioned a point earlier, which is how the popular press tends to think of things, but we don't consider ourselves, Charlie and I don't, richer or poor based on what the stock does. We do feel richer or poor based on what the business does. So we look at the business as to how much we're worth, and we do not look at the stock price, because the stock price doesn't mean a thing to us. I mean, it doesn't for a variety of reasons, but beyond that, imagine trying to sell hundreds of thousands of shares at the stock price. We can always sell the business. We're not going to do it, but we could always sell it for what the business is worth. We can't sell our stock for necessarily what the stock price is. So we look at the business entirely as in terms of evaluating our net worth. We figure our net worth went up very, very slightly in 1999, and we would figure that no matter what the stock was selling for. It just doesn't make any difference, because we do look at the businesses. We really look at it as if there wasn't any quote on the stock, because we don't know what the stock is going to do. If the business gets worth more at a reasonable rate, the stock will follow over time, but it won't necessarily follow week by week or month by month or year by year. We had a lousy year in 1999, but the stock price did not calibrate with that in any perfect or close to perfect manner. And we've had good years other times when the stock price is way overpriced or over-describe what happened during the year. So we really measure it all the time by the business. We think of it as a private business, basically, for which there's a quotation, and if it's handy to use that quotation, either in buying more stock or something of the sort, we may do it, but it does not govern our ideas of value. Charlie?
Yeah, generally I would say that if you have a lot of lovely wealth in a form that makes you comfortable, and somebody down the street has found a way to make money a lot faster in a way you don't understand, you should not be made miserable by that process. There are worse things in life than being left behind in possession of a lot of lovely money. I mean,
would you want to name a couple? No, Charlie, I mean, when farmland farmland probably tripled here in the late 70s without any real change in yields per acre or the price of the commodity. Are we going to sit around and stew because we didn't buy farmland at the start? Are we going to stew because all kinds of uranium stocks in the 50s, or you can go back all kinds of things that the conglomerates in the late 60s, the leasing companies. I mean, you can just go down the line, and it just doesn't make any. We're not in that game. We would know how to create a chain letter, believe me. I mean, we've seen it done so many times. We know the game, but it just isn't our game. Charlie?
Hello, gentlemen. My name's Dan Sheehan. I'm from Toronto, Canada. First of all, I'd like to thank you for this weekend. It's become more and more important to me as it's become more and more difficult to find rational discussion about the stock market, and this weekend really is a breath of fresh air for most of us, I think. One of the places I refer to a lot is Benjamin Graham, and what worries me now is what he referred to as a period in 1929 and the early 30s as a lab experiment where normal intrinsic values and margins of safety broke down, or seemed to anyway, and I wonder how much you think that might happen now in the next few years, and how much you worry about that with the investments you're making.
Well, we generally believe you can just see anything in markets. I mean, just extraordinary what happens in markets over time. It gets sorted out over, eventually. But I mean, we have seen companies sell for tens of $billions that are worthless, and at times we have seen things sell for 20%. A number of things, not hard to find, perfectly decent people running them, sell for literally 20% or 25% of what they were worth. So we have seen and will continue to see everything. It's just the nature of markets. They produce wild things over time. And one of those wild things, and not to get carried away when other wild things happen, because the wild things create their own truth for a while, and you have to, that's the reason they're happening, and people are getting pleasant experiences and all that. You'll see everything if you're around markets for a reasonable period of time. We don't see any great cases of dramatic undervaluation by this market. So it isn't like we're seeing, because there's perhaps this speculative mania in a particular area of the market. We do not see that creating incredible undervaluation other places. What's happening there may lead to undervaluation, a few years from now, or it may not. I don't know that, but it isn't like you can find things that are worth double or thereabouts what you're paying, because frankly there's so much money sloshing around that if you found such a thing, it would be very likely corrected by some buyout types. I mean, we would love to find businesses that are selling for half of what they're intrinsically worth. We don't find that. We do find a lot of cases where we think the valuations on the high side are unbelievable. We have been in periods in the past where we felt almost everything was being given away too. So you'll get those extremes. Most of the time the market's in a position where there's a little of both, but every now and then it gets into a position where there's a lot of one or the other. And we would love it if we could find a lot of reasonable sized companies that were selling at what we thought were half of intrinsic value. We're not finding them. Charlie?
Well, I do think that the present time is a very unusual period. It's hard to think of a time when residential real estate and common stocks and so on rose so rapidly in price, and there was so much easy money floating around. I mean, this is a very unusual period.
What's fascinating, and I'm sure you thought of it, is that you could now have a business, saw a few of them, earlier this year, we'll say, that might have been selling for $10 billion, where the business itself could not have borrowed probably $100 million in debt with an equity valuation of $10 billion. But the business itself would not, as a private business, would not have been able to borrow $100 million. But the owners of that business, because it's public, can borrow many billions of dollars on their little pieces of paper because they have this market valuation. If it's a private business, the company itself couldn't borrow 1/20th or so what the individuals could borrow. That's happened to a degree before, but this has probably been as extreme as anything that's happened, probably including the 20s. That doesn't mean there's a parallel to it, but it's been pretty extreme. Charlie?
I think it probably is the most extreme that has happened in modern capitalism. In my lifetime, I would say the 30s were it created the worst recession in the English-speaking world in 600 years. And it was very extreme. You could buy all you could eat in Omaha through the 30s for a quarter from Henderson's cafeteria. And now we're seeing the other face of what capitalism can do. And this is almost as extreme as the 30s were, but in a different direction. It's zero unemployment, rampant speculation, et cetera, et cetera. It's an amazing period.
That does not make it easy to predict, however, the outcome.
No.
It says to us, though, certain things we want to stay away from. I mean, basically, it's precautionary to us. It does not spell opportunity, although there's no question that in the last year, the ability to monetize shareholder ignorance has never been exceeded, I think.